Welcome to this explainer. Today, we're unpacking the heavily restricted, carefully tiered post-IPO share release schedule for one of the most closely watched companies of our modern era, SpaceX. You know, when a private giant of this magnitude goes public, almost all the media hype is focused on opening day. But for us focused learners, the real story, the mechanics of how wealth and equity actually move, is found in the timeline of what happens after the opening bell rings. I mean, imagine a valuation well into the hundreds of billions of dollars. How on earth does a company that massive prevent its stock from absolutely cratering the moment early investors want to cash out and buy a new mansion? Well, it requires an incredible feat of financial engineering, and we have the exact data mapping out exactly how they plan to do it.
Okay, let's dive into this, because the crucial question anchoring our entire analysis today is really simple to ask, but incredibly complex to answer. When do SpaceX shares actually unlock? We're going to skip any kind of formal agenda today and just jump straight into the chronological progression of market availability. For institutional investors, hedge funds, and us retail traders, figuring out this schedule is basically the holy grail. The reality is an IPO is absolutely not a free-for-all on day one. If everyone sold at the exact same time, the supply would completely overwhelm the demand and the stock price would plummet. So instead, what we're looking at is an incredibly precise, phased timeline that serves as a fascinating study in corporate control, market psychology, and heavily restricted equity pacing.
The absolute best way to understand this entire release schedule is to picture it moving from a trickle to a flood. That's the core narrative of this financial strategy. The company's tiered schedule begins as a very carefully controlled trickle. They don't just kick the doors open and let everyone liquidate their holdings all at once. No way. In the financial world, a sudden, massive dump of insider shares just screams panic to the broader market. It tells buyers that the people on the inside want out immediately. On the flip side, a deliberate, highly calculated trickle signals confidence. It's completely designed to test the waters, satisfy some immediate liquidity needs, and maintain absolute market stability, before eventually escalating into a massive flood of market availability when the company is actually structurally ready to handle it.
Let's move to and see how this builds right from the start. Look at how incredibly tight this initial timeline is. We are talking about strict short-term intervals, 70 days, 90 days, 105 days, 120 days, and finally 135 days post-IPO. These aren't just random sell-offs arbitrarily picked out of a hat. These intervals mark highly restricted windows for the true early believers. We're talking about the veteran engineers who were literally there when the early rockets were still exploding on the pad, and the initial investors who took a massive leap of faith years ago. Every couple of weeks in this initial phase, a new, super brief window opens up to the market, giving these specific individuals a chance to convert just a tiny sliver of their equity into actual cash.
So the crucial point is this exact number right here, 7%. At each and every one of those tight, early intervals we just walked through, early employees are permitted to sell exactly 7% of their vested holdings. Why 7%? Well, it's mathematically precise and deliberately capped. 7% provides just enough liquidity for an early employee to, buy a house, pay off student loans, or take care of their family, and this is entirely by design, it is not enough for them to buy a private island, retire, and quit their jobs. It rewards them financially while keeping all that top-tier talent firmly locked into the company's future. It completely prevents a scenario where insiders flood the market and tank the stock price right out of the gate.
To kind of tie those first few months together, the mechanics here are all about discipline. These early employee equity unlocks are granted exclusively to early employees, and they're released in those strict non-negotiable tranches we just mapped out. Most importantly, they represent a carefully controlled fraction of the overall stock. For anyone watching from the outside, whether you're an institutional analyst or a retail investor, the first 135 days of this schedule are literally a masterclass in keeping a tight leash on supply. By rationing out the shares, SpaceX ensures that demand constantly outpaces supply, maintaining incredible market confidence during the most vulnerable months of a newly public company's life.
But that ironclad discipline, that's just phase one. And a trickle doesn't last forever. We now have to shift our focus to the true climax of this timeline, late 2026. The tone of the entire release schedule gets much heavier and, honestly, far more dramatic here. We're moving entirely away from those controlled micro-tranches and preparing for the floodgates to swing wide open. Everything shifts in scale based on what happens immediately following the Q3 earnings release in late 2026. And why Q3 earnings? Because an earnings report represents a moment of maximum transparency.
It's the exact moment a company opens its books to prove its fundamental financial worth to the public. Once SpaceX proves its fundamental strength in that Q3 report, the market is structurally ready to absorb a massive influx of shares. And this brilliantly illustrates the sheer magnitude of that climax. Immediately following the Q3 unlock schedule, an additional 28% of the total stock suddenly becomes available for sale. Let the scale of that sink in for a second. We just went from careful 7% drips to over a quarter of a multi-billion-dollar company hitting the open market essentially overnight. If SpaceX is valued in the hundreds of billions, 28% equates to tens of billions of dollars of equity floating into the public market all at once. The entire liquidity landscape completely fractures and rebuilds in this one singular moment. It is a massive, immediate jump in scale that changes the entire trading dynamic of the stock. Which brings us to the next major milestone, right on the heels of that Q3 release, December 8th, 2026. At this point, we hit the 180-day lockup expiration. Now, in the traditional IPO world, this 180-day period is your standard cooling-off mechanism. It exists specifically to protect everyday retail investors from getting burned by insiders who might otherwise cash out the second a company goes public. It ensures those insiders have real skin in the game for at least 6 months. On December 8th, this traditional restriction officially expires. When that happens, the bulk of the remaining Class A shares are released, essentially permitting any remaining staff to finally sell their standard equity. The flood is now fully underway. Now, if this were a normal IPO, the 180-day mark might be the end of the story. But SpaceX implemented an additional, extraordinarily strict term, a 366-day retention constraint. This is a rigorous post-IPO holding period that pushes all the way out to June 13th, 2027. It is a full year and a day of locked-up potential. So why 366 days specifically? Well, that one extra day is a massive financial strategy. In the United States, holding an asset for over a year, so 365 days plus 1, qualifies the seller for long-term capital gains tax rates, which drastically reduces their tax burden compared to short-term sales. This specific constraint sets the stage for the absolute ultimate climax of the entire timeline, locking down the biggest players in the company for significantly longer than the general staff, while ensuring they get the most favorable tax treatment when they finally do sell. Now, what's really interesting about this slide is the tale of two massive, highly contrasting unlocking events it represents. On one hand, you have the December 2026 event. The traditional 180-day lockup expires, freeing up the remaining staff and the bulk of the Class A shares. Class A shares are basically your standard everyday common stock. This moment is huge for the general employees, but the true heavyweights, they don't enter the arena until June 2027. That marks the end of the 366-day retention constraint. This is when the Class B shares finally unlock. Class B shares are typically supervoting shares, closely held by founders, key executives, and early major institutional blocks. They represent the core architectural control of the company. So, the December event is for the staff, but the June event is for the absolute titans of the industry. And the heaviest weight of them all brings us to our final point. What exactly happens to the market on June 13th, 2027, when Elon Musk's personal Class B holdings finally unlock? When that strict 366-day retention constraint drops, the primary architect of the company, alongside the most massive institutional investors in the world, finally becomes eligible for market release. We are talking about a volume of wealth and equity that is virtually unprecedented in a single trading event. How will the broader market absorb that sheer volume of liquidity without just buckling the stock price? Will the titans hold on to their supervoting power, or are they going to diversify their unimaginable wealth? It's a date every single financial analyst will have circled in red for sure, and the answer to that question will unequivocally define the future of the stock. Thank you so much for joining me to unpack this fascinating timeline. Keep analyzing, keep questioning, and I will see you in the next explainer.